and we're going to go ahead and give you guys all the value as usual because clearly that's all you guys like. So we trade as always following the higher time frame trend, which is clearly bullish, correct? So really coming into the day, all you have to do is observe what gold is doing on the daily time frame, right? So you can tell that price is what? Making higher highs and higher lows. So that's the first step of actually making money. Where are we going? Up. So where are we going to trade? Up. 4 hour. We want to see that that's also in line with the higher time frame bias because we want to trade up. And if it says go down, well, we should wait till it says go up. Make sense? I'm going to make this as simple as possible so that you can actually do this without having to worry. So what happens here? Price is going up and we are bullish, right? You can see breaks of structure to the upside, retrace, upside, retrace. Now what are we expecting? Continuation. But we don't just jump into a continuation. We want to see low time frame signs of a potential continuation because this could just very well be continue to retrace and then go. What made it go here? So we need to see the transition on the lower time frames before it showed on the high time frame. So the 4 hour saying we can go up, the daily said we can go up. We scale down to the hourly. That's all. So from here, what can we tell about the hourly? This is where the slightest notion of liquidity starts to come in. What do you want to look for? You want to look for price points that show, okay, market liquidated lots of sellers and induced and stopped out lots of buyers also. So induced lots of sellers and stopped out lots of buyers, right? How can we tell that? Here, price is what? Going down, up, down, up, down. How can we know that this is about to go up? Well, one, we see this big candle here. See how it made a giant wick and took out this wick from what? London open. So anyone who was long during London likely got stopped out. And on top of that, we want to see the time frame right below it oppose the hourly narrative. So if the hourly is saying that we're bullish, we want the other time frame to say that we are bearish. We are exactly. So if it's bearish on the hourly, now we want to see signs of bullishness. So yes, I executed a little bit early. That's because of the liquidity sweep, but I'll show you guys both models. So look, 15-minute goes up here, market opens, and then what? Break structure, right? At this point, you get a retrace and you can enter right here. Boom. That's it. What did I use to enter? I pretty much saw one of few things. 15-minute candle building up into here. But on top of that, I anticipated the 15-minute break of structure. How? By one, looking at the hourly structure, which was a very strong wick to the to the downside. Therefore, I can expect price to continue higher. And on top of that, what happens? We get a 5-minute break of structure, which is going to signal that, oh, maybe the 15-minute is ready to change. What is that? But with that being said, that's where we position ourselves. So we say, oh, if the 15-minute is going to change, we should position ourselves, right? So what happens? The 5-minute comes into this fair value gap, at which point I decide to execute. That simple. Now, yes, you could have waited for one. This entry, price goes, break structure, right? Then you come back and enter somewhere within here. At this point, this would have been the safest entry. It would have been timed with the macro, would have been beautiful. Not that hard, right? So at this point, all you need to understand is what? Daily structure needs to justify 4-hour structure. 4-hour structure needs to justify 1-hour structure. In this case, what happened? The hourly was bearish. So we used 15-minute structure to invalidate the bearish hourly structure. Because if the 15-minute is bullish, there's a good chance that it's going to flip the hourly, considering that the higher time frame is always saying, let's go bullish. Makes sense? And that happening at specifically market open means that we're likely going to liquidate traders and then send it higher. That's simple, right? Now, does that make sense? I know it does. Finally, you just want to execute on the 1 minute or the 5-minute. So what does that mean? This will take a lot longer, so let me just do this. Sorry, but I guess you can see price play out here. That's a good thing. So, yeah, what do we see here? A fair value gap coinciding with where this order block is, liquidating these buyers right here. Boom, this is our entry point. You could have executed here if you wanted to. All the same, really. To me, I would have either found it here or I would have executed somewhere like within here. Put stops under here and ran the same trade.